Today's video is about something that has taken the investing world by surprise. SCHD, one of the most trusted dividend ETFs in America, has just pulled a shocking move, and yes, this changes everything. If you're holding SCHD, planning to buy SCHD, or even comparing it with other dividend ETFs, then you need to hear this right now. Because what just happened could shift the way this fund performs over the next decade. So buckle up, hit that like button, and let's break down exactly what changed and why every investor needs to pay attention. For years, SCHD has been the gold standard for dividend investors: clean portfolio, reliable companies, strong cash flows, and a track record that most ETFs could only dream of. Investors loved the simplicity: high-quality stocks, good dividends, consistent performance. It didn't try to be flashy. It didn't try to hype anything. SCHD simply did what it was designed to do: deliver steady returns and rising income with low volatility. But recently, something happened that caught investors off guard. SCHD made adjustments, changes that weren't just small tweaks, but enough to shift the identity of the ETF. People who have held SCHD for years are now asking the same question: is this the beginning of a major transformation? Or is this just a temporary course correction? Let's start with the big move that SCHD just made. And this is not fear-mongering. This is not hype. This is real. SCHD adjusted its portfolio composition in a way that surprised long-term holders. Key names that have been part of SCHD for years were removed or reduced, and a surprising set of companies were added. And the way SCHD allocates weight across sectors has started shifting. Normally, SCHD is very slow to evolve. That's one reason people love it. It doesn't jump around, it doesn't panic, it doesn't chase trends. But this time, the changes were big enough that investors are rethinking how SCHD will behave over the next 5 to 10 years. So why did SCHD do this? What forced this shift? To understand the answer, you need to think about what's happening in the broader market right now. Dividend-paying companies are under pressure. Higher interest rates mean investors can suddenly get 5% risk-free just by sitting in cash or buying government bonds. That's something we haven't seen in over a decade. When bonds pay more, dividend stocks lose some of their shine. And if dividend-focused companies don't adapt, they fall behind. This challenges the strategy behind funds like SCHD. So what does SCHD do? It responds. It adjusts. It tries to ensure the portfolio remains competitive in a world where income opportunities are shifting fast. Some investors hate change, but in reality, a fund that never changes eventually becomes outdated. And SCHD's latest move is all about staying relevant in a world where the old formulas don't work the same way. But the real shock isn't that SCHD changed, it's the direction of the changes. SCHD is showing signs of becoming slightly more growth-aware, more future-focused, and more selective in how it fights off competition from other ETFs. And let's be honest, competition has exploded. JEPI, JEPQ, VYM, HDV, and even high-yield bond ETFs are all trying to steal income-focused investors away. SCHD needed to send a message, and this portfolio shake-up might be that message. Let's break down what these shifts really mean. When SCHD removes long-standing companies and replaces them with new ones, that signals something about future performance. It means the algorithm, based on quality, dividend reliability, and financial stability, is detecting weaknesses in companies that once seemed rock solid. And it means stronger opportunities are emerging in areas SCHD previously didn't lean into heavily. Some investors immediately panicked when they saw the new holdings list. They said SCHD is losing its identity. They said SCHD is straying from its proven formula. But here's the truth: SCHD's formula hasn't changed. Only the companies that meet its criteria have changed. In other words, SCHD is staying consistent, but the market is evolving. And if SCHD didn't adapt, it would fall behind. Think of it like upgrading the engine of a car, not because the old one was bad, but because the road ahead requires more power. SCHD isn't trying to become a growth ETF. It isn't trying to chase momentum. What it's really doing is sharpening its strategy to outperform in a world where dividend investing is getting tougher. Now let's talk about performance expectations, because this is where investors are split. Some people think SCHD is about to become explosive again. Others worry these changes signal slower returns. The truth might be in the middle. SCHD is likely positioning itself for stability, durability, and long-term strength, even if that means the ETF won't have the same explosive years it had during low-rate environments. The new holdings could help SCHD become more resilient during downturns, more competitive against high-yield alternatives, and more balanced in a market that rewards innovation. But here comes the million-dollar question: should investors be worried? Should you buy more? Should you sell? Here's the simple answer. SCHD is still one of the highest quality dividend ETFs on the market. Nothing about the core strategy has changed. Nothing about the construction process has changed. Nothing about the objective has changed. SCHD still aims to deliver high-quality dividends from profitable, financially stable companies. And honestly, that's exactly what long-term investors want. That said, you do need to adjust your expectations. SCHD's future might look different from its past. The days of endless outperformance might be behind us, at least for now. But SCHD's long-term strength comes from consistency, not drama. It's a slow-burn wealth-building machine. It's designed to help investors create income that grows over time. These portfolio changes may actually enhance that long-term trajectory, even if they create short-term confusion. What you shouldn't do is panic. Dividend investing is a marathon, not a sprint. SCHD isn't crashing. It isn't failing. It isn't abandoning its principles. It's simply adjusting to the new financial environment. And in the long run, the funds that adapt survive. The ones that don't evolve disappear. Let's talk about something many investors aren't thinking about. What if SCHD is preparing for a major market shift? Inflation pressures may come back. Rates could fall again. Corporate debt is piling up. A recession remains possible. In environments like these, quality becomes king. Companies with strong cash flow, strong balance sheets, rising dividends, and durable business models outperform. And guess what? That's exactly what SCHD selects for. When the next downturn hits, and it will eventually, funds with weaker filters will crumble. But funds with SCHD-style discipline will likely stand strong. So yes, the changes are surprising. Yes, investors are shocked. But sometimes shock isn't a warning sign, it's an opportunity. Here's where you need to be smart. Watch how SCHD performs over the next couple of quarters. Watch how dividend growth trends evolve. Watch how the new holdings contribute to overall stability. And watch how SCHD positions itself against huge competitors like JEPI. Because the truth is, ETFs are now fighting for your money. And SCHD is making its move. If you're a long-term investor, this might actually be one of the most important moments to pay attention, not because SCHD is in danger, but because SCHD is evolving. The biggest winners are the people who understand the changes early, not the people who panic because something looks different. The bottom line, SCHD isn't going anywhere. It's still strong, still reliable, still high quality, but it just signaled that the future might look different. And your strategy might need to adjust with it. This is a wake-up call for anyone who blindly holds funds without watching how they evolve. So stay alert, stay educated, and stay ready, because SCHD just pulled a shocking move that could shape the next chapter of dividend investing. If you're an investor, this isn't the time to tune out. It's the time to lean in. And trust me, this is just the beginning. If SCHD is making moves now, more changes could be coming. And you'll want to be the first to know what happens next. Make sure you're subscribed to Stock Predictor, because I break these updates down faster and clearer than anyone else. And if you want a deep dive into the best dividend ETFs to hold for the next 5 years, check out my next video. It's going to change how you invest. Thanks for watching, and I'll see you in the next one.